In this final installment of the lectures on allocation and apportionment of multi-state income, we examine the rules for assigning to a state the sales of other than tangible personal property for purposes of calculating the sales factor. The objectives of this lecture are to understand the multi-state tax commission model rules and their relationship to state law, understand the basic rules for assigning sales of other than tangible personal property using the market-based approach, understand the basic rules for assigning sales of other than tangible personal property based on the place of performance rules, understand the nature of income producing activities associated with online sales, which are used in the place of performance rules, understand the three-tiered system for identifying costs associated with online sales, and understand the special problems associated with using independent contractors to perform income-producing activities. The Multi-State Tax Commission issues model statutes and regulations that can be adopted by the state to be used for allocation and apportionment of income. The Multi-State Tax Commission, or MTC, revised its Model Division of Income statute, known as UDITPA, in 2015, and this revised model adopts a market-based approach to assignment of sales of other than tangible personal property for purposes of the sales factor. The MTC also issued its revised allocation and apportionment regulations in 2018, which provide model regulations to implement the UDITPA market-based approach. Neither UDITPA nor the MTC regulations have the force of law. Instead, they serve as models for statutes and regulations to be adopted by states. State statutes and regulations that are based on the MTC models have the force of law. And because they are all based on the same models, the rules in most states are consistent. Therefore, the MTC model statute and regulations are a good start for understanding how most of the states will treat other than tangible personal property. Note, however, that the states do not necessarily adopt MTC models word for word. For example, the Massachusetts regulations for assigning receipts of other than tangible personal property in large part adopt the MTC regulations word for word, but not entirely. Ultimately, the taxpayer has to look to the state statutes and regulations. The general rule for other than tangible personal property is a market-based approach, but this rule is subject to a throwout rule for sales assigned to a state where the seller is not taxable. Under the general rule for the assignment of receipts or sales from other than tangible personal property, or OTTPP, the receipts are assigned to the state where the OTTPP is delivered. This is the market-based approach. UDITPA and the related MTC regulations include a throwout rule. Under this rule, if the state to which the receipts are assigned is a state in which the taxpayer is not taxable, that is, it does not have income tax nexus, then the receipts are excluded from the numerator and denominator in the sales factor calculation. We'll explain this in an example. Compare this to the throwback rule used for sales of tangible personal property. Under the throwout rule, sales assigned to states in which the taxpayer is not taxable are ignored, whereas under the throwback rule, such sales are added back to the state from which the tangible personal property is shipped and remain in the denominator when calculating the sales factor. Here's an example of the throwout rule. Webco sells online services from state X using the internet and calculates the sales factor using the market-based approach. WEBCO has income tax nexus only in states X and Y. Under the throwout rule, any receipts assigned to states other than state X and Y are excluded from both the numerator and denominator in calculating the sales factor. If, for example, WEBCO has sales of 100X, of which 10X are in state X and 15X are in state Y, and the remaining sales of 75X are in states where WEBCO is not taxable, the denominator of the sales factor is 25X, which is 100X less the 75X of excluded sales. The sales factors for states X and Y would be 40% and 60%. Here's an example of the throwback rule using the same facts. Assume the previous facts, except that WEBCO sells tangible personal property. All sales are shipped from state X, and state X has a throwback rule. Under the throwback rule, the 75X of sales to states in which WEBCO is not taxable are added back to the sales assigned to state X and are not removed from the denominator for purposes of calculating the sales factor. Therefore, state X sales increase to 85X and state Y sales remain 15X. This results in the following sales factors: 85% for state X and 15% for state Y. Most other than tangible personal property of concern in electronic commerce is either services or property that is assigned using the rules for services. So this is where we're going to start. Under the MTC regulations, receipts from a sale of a service are in a state to the extent that the service is delivered to a location in the state. This is so regardless of whether the service is delivered in person or is delivered remotely, such as delivered through the internet. Here's the rule for the assignment of sales of remote services to individuals. For services delivered remotely to an individual customer, the service is assigned to a state to the extent that the customer receives the service in the state. If the taxpayer can determine the states where the service is received, it assigns receipts to that state or states. If it cannot determine the state of receipt, but can reasonably approximate that state, it uses such approximation. If it cannot reasonably approximate the state of receipt, it uses the customer's billing address. Here's an example of services delivered remotely to an individual customer. Support Corp provides software support and diagnostic services to individuals. It supplies the services remotely to the individual customer by the internet or phone. Support Corp ordinarily verifies the customer location when providing the services and assigns sales to these locations. However, if it does not get this information, it first tries to reasonably approximate the location and assign the sale to that location, and if it cannot, it assigns the sale using the customer's billing address. Here's the rule for the assignment of sales of remote services to businesses. For services delivered remotely to a business customer, the service is assigned to a state to the extent that the customer receives the service in the state. For business customers, it's the intention that the states where the service is received reflect the location at which the service is directly used by the employees or designees of the customer. If the taxpayer can determine the states where the service is received, it must assign receipts from the sale to those states. If it cannot make this determination, under the primary approximation rule, it assigns the sales to the state that it reasonably approximates is the state of receipt. If it cannot make this determination, it uses the secondary reasonable approximation method or the safe harbor. Under the secondary approximation rule, it first assigns receipts to the state where the contract of sale is principally managed by the customers. If it cannot make this determination, then second, it assigns the receipts to the customer's place of order, where it ordered the services. Or if it cannot make this determination, it assigns the receipts using the customer's billing address, provided, however, if the taxpayer derives more than 5% of its receipts from the sales of services from any single customer, the taxpayer is required to identify the state in which the contract of sale is principally managed by that customer. Under the safe harbor, instead of using the secondary approximation rule, it can use the billing address. The safe harbor is available, however, only in a taxable year in which the taxpayer engages in substantially similar service transactions with more than 250 customers, whether businesses or individuals, and does not derive more than 5% of its receipts from sales of all services from the customer in question. So here's an example, a long example of the assignment of sales to business customers. A NetCorp, a corporation based outside of State X, provides web-based services to a business customer, Business Corp, a company with offices in State X and 2 neighboring states. Certain employees of Business Corp access the services from computers in each Business Corp office. NetCorp determines that Business Corp employees in State X were responsible for 75% of Business Corp's use of NetCorp's services, and Business Corp employees in other states were responsible for 25%. In this case, 75% of receipts are assigned to State X. Alternatively, assume that NetCorp lacks sufficient information regarding the location or locations where Business Corp's employees use the services to determine or reasonably approximate the location of services. Under these circumstances, if NetCorp derives 5% or less of its receipts from sales to Business Corp, NetCorp must assign the receipts to the state where Business Corp principally managed the contract, or if that state is not reasonably determinable, to the state where Business Corp placed the order for the services, and if that state is not reasonably determinable, to the state of Business Corp's billing address. However, if NetCorp derives more than 5% of its receipts from sales of to Business Corp, NetCorp is required to identify the state in which its contract of sale is principally managed by Business Corp and must assign the receipts to that state. Alternatively, it can, instead of using the secondary approximation, use the safe harbor if that's available to NetCorp. Here's a rule for assigning sales of digital goods and services. Sales or licenses of digital goods or services are assigned using the rules for remote delivery of services to an individual or business customer. Here's a rule for assigning the sale of intangible property that resembles a sale of goods and services. Where the substance of a sale or license of intangible property resembles the sale or license of an electronically delivered good or service, receipts are assigned using the rules for remote delivery of services to an individual or business customer. Ordinarily, such a transaction exists where the transaction does not involve the commercial sale or license of the underlying intellectual property. Here's an example. Online Corp licenses an information database through means of the internet to individual customers for their personal use. The license does not, for example, permit the customer to make the information available to others for a fee. This is a license of intangible property that resembles a sale of goods and services assigned in the same way as electronically delivered services. Sales or licenses of software are assigned the same as any other intangible. There are no specific assignment rules for software transactions as such. Instead, the taxpayer must identify the substance of the transaction and then use the generic assignment rules for other than tangible personal property. Here's an example. NetCorp licenses online use of software to Business Corp, a company with offices in state X and 2 other states. This is a license of intangible property that resembles a sale of goods or services. NetCorp reasonably approximates that 75% of Business Corp's use of the software took place in state X, and as with remote services, 75% of the receipts from the software are assigned to state X. Professional services delivered remotely are assigned in a way similar, but not the same as other services. Professional services such as management services, bank and financial services, tax preparation, data processing services, legal services, consulting services, video production services, etc., are generally assigned in a way similar to, but not the same as, other remote services. Please see the text for the specifics. But as one important difference, for business customers, receipts from professional services are first assigned to the state where the contract is managed. Compare this to other remote services where receipts are first assigned to the state where the services are delivered. Here's an example of the assignment of professional services. LawCorp provides legal services to a business client where the agreement is principally managed in state X. In this case, all receipts are assigned to state X, even if the legal documents relating to the service are mailed or otherwise delivered to a location in another state, or the litigation or other legal matter that is the underlying predicate for the services is in another state. We now turn to the assignment of other than tangible personal property using the place of performance rule. The place of performance rule was the primary rule to assign sales of other than tangible personal property in UDITPA and the MTC regulations under previous rules. With the adoption by the MTC of the market-based assignment of sales, the vast majority of states have moved to the market-based approach, which we have been discussing, but a number of states still use the place of performance rule. Under the place of performance rule, sales of other than tangible personal property are ordinarily assigned to the states where the income producing activities associated with those sales take place. Some states have adopted an all or nothing rule for assigning these sales. Under this rule, all of the sales of other than tangible personal property are assigned to the state where the largest percentage of the income producing activities take place. Other states have adopted a proportionate assignment rule, and in these states, sales of other than tangible personal property are assigned to a state based on the proportion of the income producing activities taking place in the state. Obviously, a company with income-producing activities in multiple states can have double counted sales if these states do not follow the same rules. So what are income-producing activities? Income-producing activities are those activities most directly related to earning income. Income-producing activities are generally not activities associated with the creation or acquisition of fixed assets or intangibles, even if those items are used to produce income. Income-producing activities are generally those activities, the cost of which would be considered direct costs under generally accepted accounting principles. The identification of income-producing activities in e-commerce can be done using a three-tier system. Under this system, we first identify primary functions. These are functions closely associated with the sale of a product or the delivery of a service, and are always considered income-producing activities. These functions are those that must be performed in each transaction cycle. In the context of online sales, such a function includes the online delivery of a digital product. Next, we have Tier 2 activities or secondary activities. These may or may not be income-producing activities. These are functions that are closely related to sales activities but are not necessarily performed during each transaction cycle. These include, for example, customer support services and web server maintenance. Finally, we have Tier 3 or tertiary activities. And these activities are not generally thought of as income producing. The costs associated with these activities are ordinarily not considered direct costs. These are activities that are not directly related to the sale or delivery of products and services. Research and experimentation falls into this category because its aim is the creation of an intangible and not the sale of an intangible. And the activities of management likely are not directly related to the sales or product delivery and would not be considered income producing. Once we have identified income producing activities, we must identify the costs associated with those activities and the locations of those activities. The locations of income producing activities are not ordinarily difficult to discern. These are locations at which the activities are performed. These can include, for example, the locations at which property and personnel involved in a particular function are located while performing that function. The costs of income-producing activities are the costs actually incurred based on the taxpayer's method of accounting. States ordinarily use the cost of income-producing activities taking place in a state to determine the relative proportion of income-producing activities taking place in the state. For example, if the cost of income-producing activities taking place in state A totaled 900, and the cost of all income-producing activities total 1,000, then we can say 90% of the income-producing activities take place in state A. There's a special problem involving independent contractors, and this issue only arises in connection with states that follow the place of performance rule when assigning sales of other than tangible personal property. For purposes of determining the income-producing activities in a state may or may not count the activities of independent contractors. In the past, costs associated with the activities of independent contractors were not counted as income-producing activities, and some states may continue to follow this practice. More recently, but before moving to the market-based approach, the MTC changed its rules, allowing companies to count the activities of independent contractors as income-producing activities. Here's an example where the activities of an independent contractor are counted. The taxpayer, a satellite TV producer, contracts with independent contractor IC to install satellite dishes in states X and Y and Z for $200 per installation. The taxpayer's records show that IC installed 1,000 satellite dishes in each in states X and Y, and 1,750 satellite dishes in state Z. The taxpayer can reasonably determine the cost of performing installation services in each state because the taxpayer's record indicate the number of installations in each state, and the taxpayer's contract with IC indicates the cost of each installation. The taxpayer's cost of performance is $200,000 in both state X and Y, and $350,000 in state Z. Some states may not count the activities of independent contractors. If the amounts paid to independent contractors are not counted when determining income-producing activities, this can distort the assignment of sales where a company uses independent contractors to perform income-producing services. Here's an example where the activities of an independent contractor are not counted. Webco, which has offices in State A, performs online services using hundreds of personnel located in India. Under U.S. law, these personnel are considered independent contractors. Activities performed in State A are top management activities and research. All actual income-producing activities are performed by Indian contractors. However, Webco cannot count the payments of the contractors in determining the cost of income-producing activities, since it can only count the cost of income-producing activities taking place in State A. All sales are assigned to State A. In this example, all sales are assigned to State A, despite the fact that income-producing activities take place in India. Webco can request equitable apportionment from State A, under which it may be allowed to count the cost of the Indian contractors. Whether the request would be granted is not known.